Good day and welcome back to our quarterly update video. My name is Hennie Grové. I am the National Sales Manager at Old Mutual Investment Group, or OMIG, and I'm thrilled, happy and excited to have with me here our Chief Investment Officer, Siboniso Nxumalo. Sibu, welcome back to the hot seat.
Thank you very much, Hennie.
As per usual, I asked the team for some questions and they sent me a very long list. So I hope you're ready with a lot of good responses there.
Let us see.
I think one of the key things we could start off with is TwooT. So yesterday when I got to Cape Town, went to collect my rental car, and the guy at the rental car counter saw that Old Mutual had done the booking. And so he looks at me and he says, "Old Mutual?" I said, "Yes." And he said, "You must deal a lot with TwooT." And the guy starts talking to me about TwooT. So clearly it's something that's on everybody's lips and minds. He was telling me that he left all his money alone, but not everybody is doing that. A lot of people are taking their money. We saw a couple billion in the first couple of weeks going out. I'm not even sure what the exact number is today. From someone wearing an investment hat, with people taking the money, we see a lot of retailers. We see restaurants, for example, doing ads. I've seen encouraging people to spend their TwooT money at these specific retailers. Do you see specific investment opportunities that TwooT has created with all this money that's going back into consumers' pockets? And are you changing your portfolio's positioning in any particular ways to accommodate for this?
Hennie, if you recall, I think probably about 2 months ago, we had an investment roadshow. And in that investment roadshow, we painted out how we had positioned our portfolios. And part of the positioning was that our portfolios are largely overweight consumer shares, globally, in China, and in South Africa. And why were we overweight consumer? Well, actually, we are overweight consumer because there are 3 things that we saw supporting those retailers and banks and consumer-related names in South Africa. And we saw those 3 things being, 1, the end of load shedding. So the load shedding had obviously come to an end as a country, and so that was good for the economy, it's good for employment, and so we're going to see an uptick in consumption. So that was good for sentiment, and we can see that. Second, we thought the TwooT implementation of it, as people withdraw money, generally, their estimates are somewhere between 30% and 50% will use that money in terms of spending on consumption. And also, we're heading towards Black Friday and heading towards the festive period. And so, therefore, the propensity to spend in terms of consumers is pretty high. And when South African consumers, actually even global consumers, because I think we saw something similar in Australia, where they had, during COVID, their version of allowing people to tap into their savings. And we saw the result of that actually it did boost consumption. And so that was our second one. And then our last one was the fact that we saw interest rates coming off. And so therefore we had positioned for the world that we're currently in. And so the strength that we've seen in retail shares, the strength we've seen, I suppose, in consumer-related shares, our clients have benefited from because we've owned them already, and we've then positioned that actually, should that start materializing, that our clients would benefit from that.
You took my next question. I don't know if you looked at my questions before we started the video. So I did want to ask you about interest rates.
Yes.
Exactly where they're heading. So we saw the ECB cutting, we saw the US cutting, and maybe predictably we cut as well.
Yes.
I see some commentators mentioning that we could have made a bit of a bigger cut.
Yeah.
Something like that probably takes time to work itself through the system to really see the impact. It's also something that puts money back into consumers' pockets. So going forward with interest rates, do you see interest rates coming down further, and are you making specific adjustments in the portfolios for that specifically as well? So I guess opportunities play around that?
Yeah. So I think the Fed, the US Federal Reserve Bank, the most influential central bank in the world, started off the cutting cycle by cutting by 50 basis points. And then everybody followed, and South Africa followed by 25 basis points. And so you are right that even we were surprised. Oh, well, this is not much of a cut, but it's a cut nonetheless. So to us, when we look forward, yes, we are expecting more cuts, just like we're expecting more cuts globally. And for us, we've got to step back and say, what does cutting mean, entering a cutting cycle? And a cutting cycle basically, one, you've had peak interest rates. And in those peak interest rates, that means you had peak pressure on companies and consumers in terms of holding debt and the interest rate that they're paying. And so as you cut interest rates, well, consumers and companies obviously then get more and more money in their wallet, and that then generally boosts the economy and boosts consumption. The reason you cut rates is because actually the economies are slowing and you can see the risk of a recession is there and all of that. And that's why, and we could see it in the US unemployment numbers, that actually, no, there's pressure in the system. That's why they're cutting. But whenever they cut, it's stimulative to the economy. And so therefore, for us, again, we have positioned towards those consumer names and those consumer-related shares that are going to be beneficiaries of that. And you are right, Hennie, in the sense that there's a lag. Interest rates act as a lag. It takes a while for the whole thing to actually work its way through the system. And for us, we should be paying attention to, one of the things our analysts have been doing work on, is to say, actually, if we take, let's start with TwooT, what should be the impact as we head towards the Black Fridays and the festive period? And then we say, what should interest rates be? And we start calculating that, and we can see, yes, there's been a re-rating in the companies in terms of the price has gone up, but the earnings are yet to come. And I think we're going to start seeing the earnings in Q1 next year, Q2 next year. So the benefit of all of these interest rate cuts and two-pot system that is a stimulative environment, that is going to come probably, we're going to start seeing material benefits of that in the first half of next year.
So you mentioned recession. It's something that's been lingering for, it feels like years now.
Yes.
People have been calling it recession. It
Yes.
feels like it's been building up like a pressure cooking pot.
Yes.
And with interest rates being adjusted downward now, does it take some of the pressure out of the system? So does it reduce the risk of a recession, or does it take it off the table, or is it just a reduced risk? What are your views around that?
It reduces the risk. Because one way or another, generally what has happened if you study financial history is that the interest rate, you get material cuts in interest rates when there is some form of a crisis. So if you go back to 2020, you got material interest rate cuts all over the world. Why? Because we were in the middle of a recession. In 2008, it was the same thing. 2001, it was the same thing. And so if you go back in history, material interest rate cuts are there to save the economy from recession environments. And then every other time you're adjusting interest rates, they're never really that material. And so for us at the moment, we're saying actually we are seeing a soft landing as opposed then to a recession happening. And so therefore we are looking at this and saying, well, how do we position our portfolios in order to benefit from what could be a soft landing? Because by the fact that we've cut interest rates, that means the risks then of a recession or the impact of a recession, you're already starting to pull the economies out of that risk.
Sibu, thank you very much for that. In keeping with everything that has happened over the past couple months, can you give us a summary of the last quarter? What has happened broadly in the Old Mutual investment portfolios? I know there's a lot of capabilities, fundamental indexation, quants, but if you could give us sort of a broad overview, what's worked and what hasn't worked.
Yeah, I'm going to give a summarized version. And I think if we look at the quarter, but before we talk about the actual outcomes, let's talk about what we were positioned for. I think if you look at the portfolios on an overall basis, especially the fundamental portfolios, we were positioned, like I said, we were overweight consumer globally in China and in terms of South Africa. So actually the portfolios were beneficiaries of that. So that was good for the portfolios. We were, though, however, underweight resources. And so we saw what we're probably going to speak about, Chinese stimulus. And it boosted both the Naspers process and Richemont, which are the consumer names that we own in China, but it obviously also boosted resources. So we lagged a little bit of that. So when you then sum it up and you look at our performance, in the quarter, generally the funds were second quartile. So if you look at the Old Mutual Balance Fund, that was second quartile, Stable Growth Fund, second quartile, Investors Fund, also second quartile, benefiting from South Africa, but obviously then losing a little bit in terms of resources that we didn't hold enough. Even in our core range, which is our indexation range, we saw, I think that was third quartile for the core balance fund. But the other one, the core stable and the core moderate, those were still first quartile in the quarter, which was actually a great performance given how much of the offshore positioning that they have. And the Rand, actually, which was a key factor in driving performances last month, the Rand, I think year to date, is the second best performing currency Elections were obviously good in South Africa. The market was favorable. So lots of rand strengthening. And so therefore, I think a second quartile performance. And actually, if you look at the broad range of what we do, actually, I think we should be pleased with that, given all the various forces that were there.
I think if you can consistently do that, we would all be very, very pleased with that. So good job to you and the team on that. You love China.
Yeah.
I don't know if you just love the place or if you love it as an investment destination. But talking about China, and you mentioned the stimulus, it's a huge stimulus package that they're busy with. The number I saw, and I don't know if this is 100% correct, is about $284 billion that they're basically going to issue bonds for. And a lot of that is going back into consumers' pockets to drive consumer spending. Can you maybe unpack that a little bit? What is the impact? Is it mostly in China? Does it extend globally? Does the impact extend, you mentioned Naspers process locally, does it extend further on a local basis?
Yeah. So when we looked at China, so if we start with setting the context, China has been suffering from two key things, debt and deflation. So Chinese economy has got a lot of debt, especially government debt and local government debt. So very high debt levels. And so that is generally unsustainable, and at some point that needs to be dealt with. But also they've been suffering from deflation. So the growth has been slowing. And because of all the tariffs and all the things that are going on globally, and the world has been slowing, China's the manufacturer of the world. And so therefore, the growth hasn't been great, and so there's been deflation in China. And now the Chinese economy and the Chinese market, stock market, has been lagging the global markets. And so therefore, at some point, I think the Chinese regulators obviously came in and decided, no, they were going to stimulate the economy. The key with it, though, is that they had to be different and careful about how they're stimulating it now relative to how they stimulated it in 2008. 2008 was a lot of stimulus that was geared towards commodities. But now, because of the debt issue, this particular stimulus, both monetary in terms of interest rates and fiscal in terms of actually putting out money out there, that is largely tilted towards consumer because they don't want to add to their debt burden. And so therefore, yes, this was beneficial to commodities. But I think we would also urge caution towards that, because if you look at the actual detail of the stimulus, they're cautious about how much they're putting in, especially relative to the past. It's not as much beneficial to resources as it has been historically. But it is beneficial to consumers because they need consumers to go and consume and to shop. And hence, we saw such a strong performance in Tencent, which Naspers process own, and also Richemont, because it is a good package or set of packages for the consumer. And so therefore, we saw that coming through. In fact, China moved from one of the worst performing economies to, in a week, to being one of the best performing markets globally. And so that's the size of the stimulus. And they're going to have to, though, continue to try and pull China out of the spiral or the negative spiral, economic spiral that they're in. So we should be expecting more to keep coming out of China.
Okay, so I shouldn't go put all my money in there, but it can be a potential opportunity for the rest of the world.
It is a potential opportunity because if you look at the price you're paying for Chinese assets, relative to the price you're paying for other assets globally, especially, let's say, US assets, Chinese assets are still attractively priced. And this stimulus eventually then makes itself to companies' earnings and profitability. So therefore, we should be seeing that in the months to come of improving profitability out of companies from China. And also we're seeing a lot less of, in terms of, let's say, if we deal in Naspers and process here, of the more draconian regulations that hampered those companies. And so again, that's why you saw a re-rating. And so it looks like the Chinese government is obviously more interested in boosting economic growth, and that should be good. And so for us in South Africa, as investors, given where the influence of commodities, Naspers process, and several other companies actually, this is good. And that's why we saw such big returns in terms of our market in the month of August.
Okay, maybe staying on a global theme, the other big thing that's coming up, of course, is US elections. Yes. I'm not going to ask you to predict it. That's in anybody's guess. Yeah. But there probably are risks that the investment team is thinking about, and maybe opportunities as well. Can you maybe elaborate on those a little bit? Are the portfolios being positioned in any specific way to accommodate for the, I guess, the uncertainty of the elections?
So our positioning actually precedes the elections. I think the US market over the last 15 years has been the best performing market in the world. It's been concentrated in 7 companies, the Magnificent Seven: Tesla, Alphabet, Microsoft, Apple, etc. Most of those companies performing has been driven, yes, by strong earnings growth, but actually by re-rating. Investors have been willing to pay a much higher price, largely also because of this AI mania looking forward, saying, well, this is going to keep growing. We think the expectations are too high. We think just these expectations, we're paying too big a price for earnings in the future in the US relative to every other economy. And so therefore, for us, our positioning then is underweight the US because relative to other global markets, you can get assets at actually fairly similar growth for a lower price. And also, we thought that if you looked at the dollar, the pricing of the dollar, and again, we spoke about this in one of our roadshows, that it does feel a bit high. And hence, you can see it hasn't taken much for South Africa for the rand to become the second best performing currency, because the US is entering a cutting cycle, and so therefore now you're starting to see the dollar weaken a little bit, and obviously you're starting to see investment returns. The Fed cut, but the US market did not necessarily go and run. And so therefore, why? Because it's already got high expectations. Those expectations are embedded in the price. So from our positioning, it's not really about the election. For us, it's the concern that valuations are too high. They're centered on very few companies, and it's a very concentrated and narrow market. So for us, we think that this is not sustainable. We can find returns elsewhere on behalf of clients.
I want to be a little bit unfair, as I was last time, as CIO used to at all of our funds. But if I said to you, risk is not necessarily a consideration, so all of the funds are open, and you could put your money in just one of our funds, yes, which one would you pick personally for Sibu?
I would pick our equity fund, which is the Old Mutual Investors Fund. And I'll tell you why I'll pick it. One, because of South Africa. So it's a domestic SA fund. And so we've had the elections, we've had the GNU, we've had a strengthening rand, which means offshore assets are not performing as well as local assets. And obviously, again, we've spoken about interest rates, we've spoken about two-pot system. So we are expecting great performance from our domestic assets, and that fund is full of domestic assets. The other side of it is South African assets are under-owned by foreigners. This is probably one of the lowest holdings foreigners hold. So things have gone well in South Africa, but foreigners haven't yet bought. And so again, there's that as an opportunity. And relative to emerging markets, South Africa is also still trading at a discount. And yet, when you look at our companies in South Africa and the returns they earn and their opportunity for growth, it's better, arguably, than the emerging market average. And so therefore, we've got a good story in South Africa. We've got low earnings, we've got a low price, and the world has yet to actually pay up for that. And so therefore, we just think that there's a specific opportunity there.
Okay, so basically we are coming from low expectations and a lot of things are starting to look positive. Yeah. All right. Thank you very much for that, Sibu. I appreciate you always being candid and open with your answers. Thank you very much for joining us for this quarterly update. If there are any additional questions around any of these topics that you do want to unpack, please reach out to your relationship manager, whether they be on the institutional or on the retail side. And then we look forward to seeing you in the next video. Cheers. Thank you.